Something's a little off in the global markets right now. On the surface, things might seem fine, but if you look closer, the biggest players are making some absolutely massive moves. We're talking billions of dollars shifting around in a way we really haven't seen in years. It's a huge shakeup. So let's dig in and figure out what is really going on here. And really, this quote from Bank of America just nails it. They're calling the big money managers nervous bulls. Now, that sounds like a total contradiction, doesn't it? A bull is an optimist, someone who believes the market is headed up. But these bulls, they're clearly on edge about something. And that's the central mystery we're going to unpack in this explainer. Why all the anxiety? And, the big one, if we follow the money, can we figure out what they're getting ready for? All right, first up, we have to get our heads around this paradox, because what investors are saying and what they are actually doing, well, they are two completely different stories right now. Okay, so check this out because this is where it gets really weird. This slide reveals a total split personality. On one hand, you've got sentiment, basically how investors feel about the economy, and that's actually improved a bit. But on the other hand, their appetite for taking on risk, it is absolutely cratered to an 11-month low. It's like they're saying, I feel great, but they're investing like they're terrified. And this isn't some small little shift either. We're talking about nearly a quarter of all fund managers surveyed actively taking less risk than they normally would. That is a huge chunk of the market battening down the hatches. They are absolutely acting scared. Which brings us to the investigation part, right? If they're moving out of all these risky assets, where on earth is all that money going? Let's follow the trail. So the first big shift is a classic move. It's a flight to safety. Money is pouring out of what we call cyclical stocks, things like energy and materials that really only do well when the economy is firing on all cylinders. Instead, it's flowing into defensive sectors. Think about companies that sell stuff we all need no matter what, like the electricity to keep our lights on or the toothpaste we buy every month. This is the biggest pile-on into these safe haven stocks we've seen since the crazy uncertainty of mid-2020. But wait, it gets even crazier. This next shift is a real bombshell. For the better part of a decade, tech has been king. It's been the unstoppable force. Well, not anymore. Fund managers are dropping tech stocks and rotating that money into banks. Banks, they've suddenly become the world's favorite sector. That is a massive, massive vote of no confidence in the tech giants that have been carrying the market for so long. And this rotation isn't just about what kind of companies are buying. It's about where they're buying. Get this, we're seeing the biggest drop in allocation to U.S. stocks ever recorded in this survey. That is a huge deal. And where is it going? A big chunk is heading over to the Eurozone. The pros are essentially betting that the big wins in the near future might not be coming from America. And this chart right here, it just ties it all together perfectly. It's the whole story in one picture. So let's break it down real quick. The bars on the right, that's what we call overweight. It's just Wall Street talk for putting more money into something than its normal share. And look what's at the top. Banks, healthcare, and staples, all those defensive plays we just talked about. Now, look to the left. These are the underweight sectors where they're investing less. And who are the biggest losers? Energy, and most shockingly, technology. The message could not be clearer. Defense is in, high growth is out. Okay, so we've seen the what, this massive rotation into safety. Now it's time for the why. What specific fears are driving these dramatic moves? This slide gets right to the heart of it. It shows us what's keeping these investors up at night. These are what's known in finance as tail risks. Those low probability but super high impact events. And if you look at the chart, that top line represents the biggest worry by a long shot, with 55% of investors pointing to it. A trade war that triggers a global recession. That single fear is coloring every decision they make. And there's a second fear, and it's tied directly to this. For years, it's just been a given that the U.S. market would outperform everyone else, a trend they call U.S. exceptionalism. But as you can see here, a massive 69% of investors, that's almost 7 out of 10, now believe that era is over, that it's peaked. And that belief is exactly what's fueling that record-breaking rotation out of U.S. stocks we saw just a minute ago. But here's the twist. You got to remember the full name. Nervous bulls. They're not just running for the hills and hiding. All this defensive maneuvering, it's actually setting up their next big play. Right. So this isn't about being a pessimist forever.
Bank of America's analysis suggests the reason they're playing defense now is because they're actually anticipating a hot-running economy in 2026. They're trying to weather the storm today so they can be ready for the sunshine they see on the horizon.
And they believe that future rebound is going to look really different from what we're used to. The money moving into banks, industrials, even smaller companies. It's a bet on a broader, more domestically driven recovery. It's basically a move away from relying on that handful of tech titans that have powered the economy for years and towards a much wider base of growth.
So, what's the takeaway for the rest of us? How can we take what these institutional giants are doing and turn it into a smart playbook for our own financial thinking? The whole strategy we've been talking about is called defensive investing, and it's the key idea behind this entire rotation. The philosophy is actually pretty simple, but it's super powerful. As this slide shows, the goal isn't to hit home runs, it's to avoid striking out. You're basically accepting lower highs to ensure you get higher lows, protecting your capital so you're ready to play when the storm passes. And the best defensive tool you have isn't a stock or a bond, it's your mindset. It's what we're calling the patience play. Let's just run through it. 1, don't panic sell. History shows us markets always recover. 2, think long-term, years, not months. 3, tune out the daily noise that's designed to feed fear. And 4, and this is so key, use this time to review your plan, not to react emotionally and abandon it. This is how the pros stay disciplined.
So when you boil it all down, here's the deal. The smartest people in the room aren't panicking. They're repositioning. They're playing defense not because they think the game is over, but because they're strategically getting ready for the next play. And that leaves one question for all of us, right? Are we?